Welcome to the Bekaert Tax Beat, a conversation about tax that matters.
Welcome to the Bekaert Tax Beat podcast. Today's session will be about the world of retirement plans for employees and business owners. The Secure Act was signed into law in December of 2019, but it was quickly overshadowed by the CARES Act and pressing needs of the coronavirus pandemic. All right, joining today's discussions are two of my colleagues who bring their insights and experience working with employer plans. So, David, introduce yourself.
Hi, all. David Flinchum here, CPA firm partner with well over 30 years of experience. Most of my practice involves consulting, designing, dealing with compliance issues, and reporting issues pertaining to qualified retirement plans.
And Jeff.
Yeah, I'm Jeff Gump. I'm in our Virginia Beach office. I also spend a lot of time in our Raleigh market. I'm a financial advisor with Bekaert Wealth Management, which is a wholly owned subsidiary of Bekaert. I've been in this business 20 plus years, pre-tech bubble, so that shows you how long I've been in the investment side. And I mainly work with high net worth individuals and then business owners and retirement plans.
And Sarah, say hello as well.
Hello, this is Sarah McGregor calling in from Greenville, South Carolina again, and excited to learn more about this topic.
And I'm Brooks Nelson. I'm sitting here in downtown Richmond, Virginia. So Sarah, how's life treating you?
Life is good as always, Brooks. This time of year when school's starting back and it feels kind of fresh and new and like fall is around the corner, but you get these last wonderful weeks of summer. So I'm pretty excited about it.
Well, I went to an outdoor concert last night and there was nothing like fall weather that I was experiencing. It was about as moist as you could possibly get. But the concert, it was Wilco, by the way, but it was as good as it could get as far as the music. All right, so let's switch over to our retirement plan discussion. So again, the Secure Act, which stands for the Setting Every Community Up for Retirement Enhancement Act, was enacted December 2019. It had a lot of provisions pertaining to retirement plans, of course. It extended the due date to establish certain plans. It increased tax credits for starting up plans. It added flexibility to adopt in 3% and 4% contribution safe harbors. It enhanced automatic enrollment options and open plan participation to part-time employees. I will say subsequent to that, as I also mentioned, the CARES Act came out in response to all the COVID pandemic economic hurts. And as far as CARES, there were some fairly well publicized provisions pertaining to retirement plans, mainly how employees, associates could draw money out in forms of loans and distributions, and gave some very favorable tax treatment on that. We're not going to spend a lot of time in that area right now in this podcast. So let's move on. So David, as you said, you've been doing this for an awfully long time. What are the top 3 questions you are asked most often in the retirement plan realm?
That's a fun question. Before I answer that, I'd like to mention a couple of other really neat things about the Secure Act that may be long overdue. The act also extended by 2 years the date on which we need to take our minimum distributions from our IRAs and plans. So it was 70 and a half, and now it's 72. And if I recall correctly, that act dropped the age limit for making IRA contributions. So we can continue as long as we have earned income to make IRA deposits well after 70. But your question, Brooks, is a fun one because, and it's the number one question I get is typically from owners of business or principals of businesses. And the question is, Dave, how can I get more money into my retirement plan? You tell me that, I can only get, $58,000 a year into my 401k plan, but that usually is very expensive because I've got to cover all of my other employees within certain limits. And I say, well, let's think about this. Maybe we can redesign the plan that would allow you and other owners and or principals of your business to get the maximum 58,000 or maybe 63,000 if you're at least age 50. And we can do that and hold the cost of funding for everyone else down to an affordable level. So finding the right plan design where the uniforms aren't necessarily, or where the allocations aren't necessarily uniform, but rather they're skewed to certain targeted owners and employees of the business. And believe it or not, oftentimes we do find good outcomes where we can design a plan and allow an owner or principal to achieve the maximum contribution in a 401k profit sharing plan and holding the contributions to the staff to a minimum amount, sometimes 3 or 5%. So that's the number one question that I get. The other questions that I get typically involve something called a backdoor Roth IRA, or now even a mega backdoor Roth IRA. So we talk about the benefits of a Roth IRA, and then we talk about what an after-tax or a backdoor Roth is, and in its simplest form, the ability to our ability to deposit in a Roth IRA is basically hinges upon our income. The other question I mentioned is the mega backdoor Roth IRA, and that involves a 401k plan that is modified to allow an employee to contribute some of his or her pay on an after-tax basis. And then once the contributions are made to the plan, that worker can convert the after-tax contributions into a Roth IRA.
Most employers are looking at this plan. What is the most efficient way for me to design this so that I get what I want, and the total plan makes sense from a business perspective? But I don't want to undersell the fact that you still, the more you give to your highly compensated group in general, the more you have to give to all the associates. And there's still some great benefits to be associated with giving retirement plan, qualified plan dollars to your associates, and they come in all sorts of different ways, from employee satisfaction as well as kind of a golden handcuff. I don't know if Jeff, you want to add something on that?
Yeah, on the golden handcuff, certainly. The employment market is extremely competitive right now. So, your retirement plan and the matching inside there better be competitive with your competitors, or you could lose out on an employee. And obviously within there, some of the profit sharing that's above safe harbor, so some additional profit sharing dollars can have a vesting schedule of up to 6 years, so that can help keep employees around. And again, not a topic for this call, but there's certainly some non-deferred compensation strategies that we can use to put golden handcuffs on key employees to incentivize them to stay around.
Right. Well, and again, if we're just talking about a fairly simple 401k plan and a match, maybe there's not enough in there to prohibit an employee from leaving. But if you get into some of these more advanced plans that we'll talk about in a second here, that can provide an incentive. All right. So let's going back to you, David. So we talked about the Secure Act. I think one of the most important items of the day is the change in timing for establishing certain qualified plans. So what's your thoughts on those?
I think this was a great part of the legislation that came out within this act. Prior to 2020, in order for an employer to take advantage of these retirement plan benefits, the plan agreement had to be in place and executed by the end of the calendar year or the plan year. And what this act did was it actually now permits an employer to adopt a qualified plan as late as the due date of the employer's tax return. So it is, it's August now, and we're going to have a lot of tax returns, falling due in September and October, those that are under a valid extension. And those employers still have the opportunity to adopt a qualified plan and to make a tax deduction for 2020. Even those cash basis taxpayers, this is an exception, to that cash basis where we're allowed to tax deduct any accrued contributions, say now for 2020, as long as we pay those contributions by the due date of our extended tax returns. So this is a great post-mortem tax planning opportunity. I'm having conversations frequently with employers and self-employeds and others who might be surprised at a tax bill at this point, and who might be even facing penalties and interest because they didn't pay their taxes, by April 15th or, the due date. And we're going back and we're installing plans and accruing contributions to offset the tax that they would otherwise have to pay. So it's just a great postmortem planning opportunity.
And David, there was some recent news about from the IRS giving some relief for filing forms 5500 for 2020 year plans that are set up now. I mean, we're already past the first initial due date for 5500. So this was great news as well.
And welcome news. And this is one where the IRS did something that actually just made a lot of sense. It was a very practical announcement. And the announcement was just made a couple of weeks ago, because we still have an opportunity to adopt a plan for 2020. But Sarah, as you said, that 5500 was due a month and a half ago. Right. So there's no way that we can go and backfill a 5500 that was due, last month. So we get a complete pass. You adopt a plan now for 2020. You don't have to file the 5500 for 2020. And as I understand it, the first year that these plans will file, a 5500 will be 2021. And there's going to be a checkbox on that form that will indicate to the government that even though this is our very first filing, we actually implemented the program a year ago.
And David, there were some enhancements to the tax credits for small employers that are also establishing plans.
Yes, Sarah, this is I think it's a credit that's out there and it's just not being taken advantage of. It's just an oversight, I think, by either the employer or their tax advisors. It's a great credit. It's actually been on the books for a couple of years now. It's an incentive for small employers to adopt retirement plans, for their employees. And the credit it's available for the first 3 years of the plan. And the credit is it applies to corporations and it applies to pass-through entities. And the credit is available to a small employer, and that's fewer than 100 employees. And there has to be at least one non-highly compensated employee. So, a sole proprietor, a consultant, a contractor cannot take advantage of the credit. But for any employer that has at least one non-highly compensated employee, the credit is available. The credit can be as much as 50% of the actual cost that employer incurs to adopt, implement, educate, and run the plan. To file the fees they pay to file the 5500s and do the compliance, the fees that they pay to set up the plan, for feasibility, to purchase the plan document. So up to 50% of those fees for the first 3 years of the plan the federal government will provide a credit. Now, there are limits embedded. In other words, the credit cannot exceed $5,000 a year. And the minimum amount of credit is $500 a year. But when you think about it, a credit is as much as $15,000 over the first 3 years of the plan's life will go a long way to almost or completely subsidize the cost of installing and running that plan. So I would encourage all employers who have adopted or are considering adopting a plan to remind their tax advisors that they have installed a plan and the credit is available.
Great. Jeff, I'll ask you the question that Brooke started out with. What are you seeing as the hot topics for retirement plans from your practice?
Yeah, so there's really 4 things out there, Sarah, that are I've been hearing a lot about. First one, cybersecurity. I think that's across almost every industry. That's certainly a concern because, participants' assets are inside of these plans. So making sure that all the systems, are secure. So that's a big one for sure. And a concern everybody's having. Auto enrollment, auto escalation has for the last couple of years and continues to be a big deal. And an auto enrollment is just where every new employee is automatically enrolled in the plan. And then auto escalation is maybe you start everybody at 5%, and then each year you increase them by 6%. And they have the ability to opt out of that or go back and change it down. What I'll say is there's a lot of unnecessary heartburn when you bring that up. They think that employees will get upset by it or they won't like it. But what we found is there's typically inertia. So you set it in place and very few participants go back and change anything. And that's a good thing because it really improves the outcome for the participants and enables them to retire at some point. So that's a major positive. And then the other thing the company gets is if the plan needs to be tested, it's had a better chance of passing testing. And testing is quite simply that the highly compensated employees, if they don't pass testing, then they can't fully max out their own employee contribution. So that could be helpful depending on what kind of plan design it is. And I'm not going to dig deep into that. And then the other 2 items that have definitely come into play in the last year or 2, stable value funds, which are a lot of times the fixed income option in the retirement plans, are starting to get a lot of scrutiny for the high internal expenses they have inside there. So we've definitely started to take a deeper dive there. And then the other part is target date funds are obviously extremely popular, and they're great because they're a diversified way for participants to get in. And, the old Ronco set it and forget it. But now we're starting to have to really look at what are the fees of those target date funds and how do they compare to their peers to do a target date analysis.
So, Brooks, you served as trustee for Retirement Savings Plan. What has been the influence of the automatic enrollment and automatic scaling?
Much like Jeff just said, we had some concerns that maybe there would be some pushback from employees when we adopted these type of provisions, but almost across the board, they have been embraced, I would say. Almost very little criticism from it, and overall appreciation for just taking something off my plate. So along with the auto enrollment, it puts you in a appropriate target-based fund for your age, or at least that's typically what you see, and an automatic escalation of your deferral percentage each year for several years until you get up to a set percentage. And I think most people are just glad that you're taking care of it. They don't think about it and they never see it. They never feel the pain of it leaving their paycheck because it's kind of incorporated from the start. So it's just been very positive, and it's and I think you see when we get to the end, when employees have retired that had this set up, they were almost shocked at how much money that this had accumulated on them from it. So nothing but good things to say from my perspective.
Right. And Jeff, and then David, if you'll comment as well. I think there's a renewed interest in defined benefit plans. not the old pension plans of manufacturing conglomerates of the past, but a different kind of flavor for a defined benefit as opposed to a defined contribution plan. Can you start, Jeff, a little bit about that and what you're seeing in your practice, and then David, you as well?
Yeah, lots of businesses are luckily having great banner years, or the last 2 years, even because of COVID. So surprisingly enough, and even this year, we're starting to have a lot of conversations around owners, partners, maybe targeted C-suite executives that they've maxed out their 401k. They might be putting the $58,000 between the employee and employer contribution if they're under 50, or the $64,000 in the plan, and they're saying, hey man, if I could put away more pre-tax dollars, I'd love to do it. And there's certainly some ways to do that. The tax deductible contributions could be as high as $338,000 for the right case design and an older employee. And this is especially coming into play because there's a fear that higher taxes are coming. So if they can do some planning and put away more pre-tax dollars, it's pretty attractive, and people are starting to ask about it.
I agree, Jeff. And, we started this conversation with, with a question to me, what are the hot topics? What's the big ask out of you, Dave? And the first thing I said was, owners and principals, they want an opportunity to contribute more money to their retirement plan each year. And often the solution is adding a second plan into the benefit mix. And it's typically a cash balance plan. And just echoing Jeff, the 63.5 is not enough, and we're having great outcomes where owners and principals are now enjoying annual deductions into their own accounts for $200,000 and more. So it's I don't see cash balance plans often with larger employers, like 500 employees and up. Those, some still carry the old-fashioned pension plan, but I'm not consulting and designing plans for that size employer. Typically, it's an employer with, maybe it's a consultant or a self-employed person. Up to about 50 employees is generally the targets that I've been seeing adopting these plans of late.
All right, so we were talking about cash balance plans, Jeff. So our firm also offers a plan called variable interest plan. Can you just briefly talk about what's a variable interest plan, maybe what a cash balance plan is as well, and a brief compare and contrast on that issue?
Sure. So I know internally we call it the VIP plan, but the official name of it is the Direct Recognition Variable Investment Plan. So just a quick correction there, but again, internally we call it VIP. So, and that's pretty much what our clients call it too. It's similar to a cash balance plan. It has a little more flexibility, has some bells and whistles, but you pay for those additional features. And I liken it to the old Lexus Camry. Camry's maybe the cash balance. It's going to get the job done, but the VIP is like the Lexus. It has some additional bells and whistles, but for that you pay an additional cost to get that additional flexibility. It's pretty unique. We do it in conjunction with Cherry Bekaert Benefits Consulting, which is our benefits consulting group. The benefits consulting group acts as a record keeper and an administrator of the plan, or the TPA. Charles Schwab's the independent third-party custodian, so that's who holds the assets. And then Cherry Bekaert Wealth Management many times is the advisor on the plan. So we really help with the investment side of things. As Dave mentioned, this is really just layered on top of the 401k plan. But when I say layered on top, it's very much the plan design is integrated. When you integrate the 401k contributions and the plan design, really to maximize the contribution to your targeted employees.
So every plan is different. Every plan has specific designs. Different people are different. But what's the top end of benefits that you maybe see in the VIP plan?
You said the top
The top range of the amount of money you can put away, the contribution levels.
Sure. So it's up to 338,000. Again, this is an actuarially tested. So it can be up to 338,000 when you combine the 401k portion and the VIP contributions. Again, that would be an older employee. The younger you are, the less you can contribute in that. So like I said, we typically have the benefits consulting group run a plan design and say, hey, here's the maximum amount you can put away, and here's what you'll need to contribute to your employees. And then typically the main key partners or the targets go back and say, yeah, I can do that, but here's what I can afford. And then we really look at it and say, okay, if we do that, how much money are we able to put away for the key targets versus how much are we going to have to give to the employees?
All right. And David, I guess maybe, your 2 cents on the difference between the VIP and a standard cash balance plan.
Sure. Excuse me. It's a big difference, and it's an important difference. A traditional cash balance plan generally provides a fixed annual contribution to an eligible participant, as well as a fixed annual rate of return to the participant. And most cash balance plans these days provide a fixed rate of return of 4 or 4.5 or 5%, right? So regardless of how the underlying plan investments perform, a worker or a participant in a cash balance plan will always get the same rate of return credited to his or account every year, right? That's a traditional cash balance plan. The dilemma with a cash balance plan that we most often find is when the underlying investments don't perform up to the fixed rate of interest. In other words, your cash balance plan provides a fixed rate of a return to each participant each year of 4.5%, but the plan investments only return 2%. Well, the employer is obligated to fund, the deficit or the deficiency. We call that underfunding, and that's kind of a significant drawback when we're talking about traditional cash balance plans. And often it becomes a non-starter because an employer really doesn't want to undertake that risk. A VIP or a variable interest plan, we call that an actual, code name is an actual rate of return plan. So at the core, the contribution limits, as Jeff mentioned, the 338. At its core, the VIP and the traditional cash balance plan are generally identical in terms of plan design and contributions, but instead of having a fixed rate of return, the actual rate of return that the plan's underlying investments earn are allocated to the workers. So essentially, there's no underfunding risk. That's very valuable to employers, and it often when we're comparing one to the other, the VIP often will score much higher because we've eliminated the underfunding risk at the outset.
Right. And just to add on that real quick, David, the VIP contributions are pooled together, and really they're invested for the firm's overall objective. And so the participants their benefit goes up and down as that account increases, and it's everybody in the plan is going up and down directly. So as David said, yes, their benefits can increase or decrease, but this takes away that or mitigates that traditional underfunding risk that you typically have with a cash balance plan. So the contributions are known, consistent, and reliable. So that's where it can be a little bit different.
And by combining these plans, defined contribution plan with a cash balance plan or the VIP, you are allowing for some flexibility in years which might not be as profitable as others. So you can control that deferred contribution side where you still need to make those payments for the defined cash balance defined benefit plan side. David, I wanted to go back to your comments on the Roth and just pick a little bit of roundtable between all of you guys about your feelings about where a Roth savings plan fits into an overall retirement plan savings.
I'm a big fan of the Roth. I have a Roth. I think it is should be a part of one's wealth accumulation strategy. I like the diversification. I like the idea of a permanent tax-free investment savings account. I like the idea that when I reach age 72, God willing, I won't have to take a minimum distribution like I will have to from my non-Roth IRAs. Big fan. For certain high earners, they are constrained in funding opportunities. So we have to kind of get creative on how higher earners can actually take advantage of the Roth.
And I will just say, I just want to echo David's comments. I agree. I think it's a good tax diversification strategy. And with the caveat that the longer you're in, the more sense it makes. So it's not a short-term play, but on a long-term, certainly there's an accumulation of the benefits of not having your earnings taxed. Okay. I think that's good for the Roth. So I think we're kind of at the end of our podcast here. I guess I just want to do a little bit of a wrap-up comment here. In my mind, retirement plans are a fantastic thing. When you're working with these qualified plans, you get tax deductions up front, unless you're, of course, going into this little Roth space here. But in the big picture, as an employer, you're getting a tax deduction up front. You're paying, you're allowing money to accumulate tax-free over large amounts of time, and then you're pulling them out. You get all sorts of protections from bankruptcy, creditors, and all other side benefits that are economic benefits that we're not really going into. But just from a tax play, a cash play, financial play, security play, it accomplishes so many cool things here. So we've got all this interesting legislation that's going on here. So it's just all the need. If you haven't checked in with your advisors, it's a good time to do so. If you haven't, particularly if you don't have another plan. Sarah, do you have any other final comments you'd like to add?
I was just going to say, for those not to miss the opportunity to take advantage of setting up a plan to cover a 2020 contribution, there's still time now. Before the tax return filing deadlines, and I think it could go a long way towards helping people with their tax liabilities and consequences. And starting now is good for 2021, because you've got between now and the end of 2021 where employees and employers can make contributions for this year as well.
Right. So even if you filed, it's a good time. This is more the traditional cycle if we were looking for the current year as it is now. All right. All sounds great. So thank you for listening to our discussion on the latest trends in qualified retirement plans. Quick disclaimer, we're not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Bekaert, with your specific tax issues or to discuss information from today's podcast. Check out our firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Thank you, David. Thank you, Jeff. Thank you, Sarah. Thank you, our listeners, for spending your time with us. We truly appreciate it, and we would ask you to please share, like, or subscribe on this podcast. So let's call it a day. Go forth in peace.